What if the key to consistent trading success was hidden in plain sight? If you're the type of trader that sits down at the charts and gets lost in all the movements of the market, then I'm here to clear up your confusion. Before I figured out what I'm about to share, I was just like you, always trying to pick the reversal and just overall not knowing which direction the market was going. This led to a lot of bad habits like over trading and over leveraging because I thought I was seeing things that weren't really there. Now, if you don't know who I am, my name's Kyle and I've been trading the markets for the last 13 years. I've learned so much in that time span, but it wasn't really until the last couple years where I've seen massive results. I even went on to make over $1 million starting with a very small bankroll. And if you don't believe me, here's some of the receipts. Now, what got me there? A deep understanding of market maker models. So in this video, we'll discuss every aspect of the market maker model and how you can implement it in your trading. So without wasting any more time, let's get into it. All right, so let's cover market maker models. And the first things that we're going to talk about, why are they important? How can I trade with them? And some things to be aware of. So first of all, why are they important? So the biggest reason why I believe a lot of traders fail in the markets is because they don't recognize the market condition that they're in or the expectation that they have from the market. Maybe they're trying to pick reversals when, the market might just be going through a consolidation phase or an distribution phase or an accumulation phase, and not knowing that there is a specific draw on liquidity that these markets are reaching for. And at times, they just take time to get to. And I think that's where a lot of people's impatience come into play, and they just don't have the ability to read the market past a certain point in time. They can't predict a market that is moving extremely slowly, and they don't have the patience to hold it to see their idea pan out. And I think that's where a lot of traders fail, because in a backtesting environment, they could just fast forward. And the problem is when they go into a live environment, there's no fast forward button. So your expectation of when a trade might pan out is just not in line with your ability to read the market and trade the market, because you have this unrealistic expectation that as soon as you enter the trade, it should start going into the green, and then you're just in profits all of a sudden. So when they're planning a trade, maybe using a market maker model, they just don't know how long they might be holding that trade for. And the reason why this is important is because at times we might take losses. That doesn't mean that our trade idea is wrong. It just might mean that we're going through a consolidation period, a distribution or a redistribution or an accumulation or a reaccumulation. And by the time it hits that final target, you might have been shaken out of the trade already. And I'm going to go over just a couple examples of that using just a very simple infographic. And this infographic, obviously this visualization, it's not going to pan out exactly like this in the market, but if you can spot it and you can be aware of specific levels that you're trying to trade to, it becomes very, very important. So one thing that we're going to talk about, and I'm really just going to cover a bullish market maker model, just because it's very easy to kind of understand. So really what happens on during a bullish market cycle, we might have a pullback. So let's say if we have a pullback that's running lower, but it's still overall bullish, we might trade into a specific level. And then when we turn around, we're going to start attacking some of the levels that were created on the sell side of the curve. And then we have the buy side of the curve. So we have two different curves, all right? This will be sell side and this will be buy side. And then you're just going to flip it if you're looking for a bearish market maker model. You're going to have a buy side, right? And then a sell side. And then the sell side will start attacking the buy side. So really we're just looking at overall market structure and the flow of the market. So we're going to have mark up and mark down phases. We're going to have original consolidations. And then we're just going to have periods in between where it's maybe reaccumulating or redistributing price. And then it's going to make another run towards that higher time frame level. All right. So the important part of all of this is just knowing what condition that you're in, and being comfortable in having that higher time frame target, and knowing that you might have some periods where the market might move sideways for a bit. All right. And this is all going to tie into how to determine, low probability conditions, when to avoid specific trades, or when to expect trades that go into consolidations, right? How do we determine a market that is going to enter a consolidation? That's probably one of the hardest things. And then when is going to exit the consolidation? All right. So, why are they important? So obviously, again, We're just looking to understand the market condition. Is this market predisposed to go higher or lower? Or is it going to go sideways? All right. So just a very quick visualization of what we should be expecting. So we have a higher time frame, a key high time frame level. This could be in the form of an old high or bearish order, fair value gap, bearish order block, just something that would possibly cause the market to turn around. All right. And then we might get an original consolidation that forms after taking out that key high. So a lot of times you might see, previous weekly high being taken out or previous daily high being taken out. Maybe it's a previous monthly high, or maybe we're trading into a higher time frame bearish fair value gap, for example. And then we're going to consolidate in there for a little bit. At this point in time, we don't know if that key level is going to hold and send us lower again, or if it's going to run higher. And this is really the part of patience that you need to have, because we're trying to find a bullish entry. All right. So once we trade to the high time frame level, we have to expect that maybe we're going to get some type of pullback into an internal range liquidity point. So this will be our lower key high time frame level. So after we take out a old previous high, or we trade into a bearish fair value gap, we might see an original consolidation and then a pullback, trading deeper, and then maybe down into a key high time frame level. So in a bullish trend, we're going to have bullish fair value gaps that are being printed on the way up. And then when we hit those higher time frame levels that are on the premium end, we might expect a pullback into one of these levels that are inside of the range before it runs higher again. So if you're just thinking about, let me just delete some of this and I'll give you guys an example, right? So if we have a bullish market that maybe trades above this high, all right, we're just really expecting it to trade lower again into some level. And then this high time frame level might be what? An old low or a bullish fair value gap. So that bullish fair value gap might rest in here. And then we're just trying to position ourselves long again to run out the previous high. All right. So that's really all we're expecting. This is really just going to be a retracement from the higher time frame. All right. We might have a distribution where let's say we haven't traded down into a discount or that specific level that we're expecting. Then we might chop around and then flush more people out of the market. But once we hit this key high time frame level, what we're going to look for is a displacement. All right. So we need to see some type of displacement away from this old low or away from this bullish fair value gap. And that's going to be our key to expect. Maybe we're going to start targeting some of the sell side of the curve. All right, so this, all of this, and there could even be multiple levels of distribution in here, which some of the examples I'll show you. There might be multiple levels of distribution in here that we might target after we get that smart money reversal. All right, I'm just showing you guys an example of what it might look like. Now, again, it doesn't pan out picture perfect like this every single time. It's about you recognizing that there is liquidity at certain points on this sell side of the curve that we can possibly target as we run higher. All right, once we get this displacement, we might have fair value gaps in here, we might have OTEs in here, and we might have breakers in here, all right, or mitigation blocks, something like that. And then we might have a period of chop and sideways, and this is probably where a lot of people get thrown off out of their trades. Maybe we'll get stopped out a couple times, and then at some point we're going to have another markup phase, another reaccumulation phase, and then eventually running back and then creating new highs again. So in a bullish market, this will consistently happen. We'll have highs being created, come back down, higher lows being created, and then higher highs being created. All right, so inside of a higher time frame structure, we're going to have market maker models on the lower time frames. All right. And this is just a very crude depiction of what you might expect in the market. And the biggest realization that you have to have is that you have to kind of anticipate when we're going to possibly break out of these specific stages, because arguably the best times to enter are when the markets are trading sideways. All right, because when the markets expand and you get the mark down and mark up phases, there's not going to be deep pullbacks, right? This is the pullback that we're waiting for, the distribution leg or the accumulation leg. So that's a way you're going to be able to eliminate FOMO. And the best trades are oftentimes when you can get in during the range. So getting in when the market is ranging, right? There's a reason it's being held in that range. And so smart money can accumulate more and more orders at that specific price level before price runs away. And when price is running away, oftentimes it's not going to come and pull back, and you're not going to get that entry. All right, you have to be in the position and position yourself inside the markets before it makes that expansion run. And that's the biggest difference between people that really are profitable and people that chase those moves after they break out, right? So here's just a couple examples that we're going to cover, and I'll kind of walk you guys through this. So, you know, how do I know that there's going to be that original consolidation is going to be ran out? Now, one thing that I will point out is when you're trying to find an original consolidation that is going to be ran out at a later date, what you kind of don't want to see is one big spike higher and then trade lower, because that oftentimes will signal a smart money reversal, or it might be a high resistance liquidity run. So what you're looking for really is an actual consolidation that's visible, that is either producing a low resistance liquidity run, which is a whole different video, or a level of clean highs and lows. So when the markets are very clean and it's printing double tops or triple tops, those are often those original consolidations that are prone to be ran out. Now, when you get that one big spike higher and then a market trading lower, I'm not really looking at that for a possible market maker model. So I'm not really looking for this to smart money reversal the other way and then trade higher. All right. The problem is this is the smart money reversal that's really occurring, and then maybe this is just a distribution leg, and then we're going to trade lower. All right. So just a tip for you guys to write down when you're trying to spot the original consolidation. All right, it really should be a consolidation where price is held sideways for an extended period of time. All right, so just as this picture is depicting, we have a triple top. All right, we don't want to just see one high being created and then we're going to use that as our target, because oftentimes that's not really going to help you depict the market maker model. All right, and you have to be able to determine where you are in that market maker model and where the target is, so the eventual target. So this is our initial consolidation. You can clearly see that it's been held sideways for a very long period of time. Now, this period of time does not matter. Don't worry about what time frame chart this is. If you can spot this on a daily chart, you can spot this on a 4-hour chart. You can spot it on a 15-minute chart. The key point is that you can spot it, all right? And that's something that I cannot transfer to you guys. Trading is really about training your eyes to be able to see things ahead of time. Not only that, but seeing the data for what it is. And that comes with experience. I cannot transfer that experience, and I can't say that you're going to understand when I have a feeling for where the market is going to go. That just comes from experience, all right? And you have to be able to train your eyes to be able to see this printing in real time, because as it's printing in real time, you're not going to have all this data on the right-hand side. Like, you're not going to have all this, and what's really going to occur is all you're going to have is the data that's to the left of you. So when we're in here, you have to be able to anticipate what might happen further from this level. So as this market's going sideways, you know, that's where your experience needs to come into play. And then you need to be able to figure out, all right, well, maybe this is just a distribution leg because we have this run lower, and then we have to run out this low down here. Okay, so this is a bullish market maker model, but you can very easily flip this to bearish, all right, because you have this level in here as our possible consolidation, and then maybe you're looking at this as a smart money reversal, right? And then this is just the distribution, and then your target's down here. But the way I'm looking at this right now, just for you guys to be able to grasp what I'm, you know, kind of what I'm walking you through, is that this is a possible bullish market maker model. So we have taken out this high time frame old low, and what we're looking for really is just a bullish displacement. So after we displace higher, right? And maybe you don't see all of this at the time of it running out this old low. Maybe you're just coming to the charts and you're saying, oh, we just ran out an old low. And then we see a bullish displacement here, which creates a bullish fair value gap. Now our gears can start turning and start thinking about, all right, well, if this is going to be a smart money reversal and we're displacing higher, and that's clearly what the market is showing, we're displacing higher. Now, where does my eye go to, and where can we possibly expect the market to trade to? All right. So, as you guys can see, we've traded down in this bullish fair value gap, and then traded past this distribution point. So after we take out this consolidation, right, this is just another lower time frame market maker model. So we might have this market maker model, maybe just trading down and reaching this fair value gap. All right, so on the lower time frame, this level right here could be your smart money reversal, and then maybe this will be your redistribution down into this fair value gap. All right, so there's plenty of opportunities in here, and this is all part of your study, is to be able to spot these visually. And at times, I can see things that maybe you guys are not seeing, and then at times, maybe you guys are seeing things that I can't possibly see myself. It's all about how you're perceiving the market and how you're analyzing the data. Right? That's what makes you the analyst and the trader. So after we take out that distribution leg, right, you can see that after we're taking out the sell side of the curve. But obviously, after we're taking out some of the sell side of the curve, we have to see some response. So it's not, markets don't just move straight in a straight line, right? We have to go through an accumulation phase. And again, this is not where, you know, it's not going to be picture perfect where you can visibly see the accumulation phase. And this is where a lot of traders will get chopped out of their trades, because it goes through a period like this where it's very sideways, very, very, very sideways. And then it's trading lower. But then, you know, as a whole, it really hasn't gone anywhere, right? We're just really stuck in this range. So you could say that this is the displacement. But even then, all of this price action here, even though it's pushing lower, it's still pretty sideways. Like, we're not getting massive displacements lower or higher. So overall, once we see a possible accumulation and then we get another candle like this, that's pretty bullish, right? What happens again? We go through another reaccumulation phase. So many times they're going to keep the price in a very tight consolidation prior to running higher until we run out that original consolidation, right? But that's really what we're looking for. We're looking for a displacement, and then we're looking to take out liquidity that's inside of the sell side of the curve. All right, and you might have multiple points of liquidity in here that's going to be your sell side of the curve. So let me remove some of these drawings, because if you were looking for a bearish market maker model, right, from a higher time frame perspective, maybe you were looking at this as a run, and then we see a possible smart money reversal. And let's just say we're trying to anticipate lower prices. Well, that's fine. We have a bearish fair value gap here. And then what are we going to target? We're just going to target the sell side of the, or sorry, the buy side of the curve on the way down. And then maybe we're just going to target this old low down here. That's if you're predominantly bearish in a market. All right. So when we're trading, it's about breaking down the charts and understanding, you know, when do I expect the market to go sideways? And oftentimes, and ICT talks about this all the time, when you get a large range day, most often that next day is not going to be what you think it is. You're not typically getting large range days back to back to back to back. So when you get a massively large range day, you can possibly expect multiple days of sideways price action if we are in a market maker model. All right. And that's kind of where a lot of people need to understand is when you miss that first markdown or markup phase, you're possibly missing out on the move already, because they're repricing it very quickly for a reason. And they may have already positioned themselves in the market prior to you actually thinking about getting in. And this is where patience and having, you know, I guess waiting patiently on your hands and just sitting in a cash position is so important. Here's another example here. And there's plenty of examples that are inside of this chart, but I'm only going to cover this one. So this is a market maker sell model. Now we have this old low down here. We take it out. We have this original consolidation. Obviously, you can see that we have equal lows in here that make it very obvious that we possibly will go lower again. So once we have this, all right, we're looking for a smart money reversal that'll tell us that the market structure is changing, you know, after we trade to a premium. So this high time frame level is a bearish fair value gap, and it's resting in a premium. So once we get this move down here, that's my indication of a smart money reversal. And then all of this on a lower time frame is just very sideways. I'm not telling you guys exactly what time frame this is, but just imagine these candles right here as daily candles. All right? Just imagine all these candles as daily candles. Now, if you were stuck in some sideways price action like this, like let's say we have the large range day like this, and then we get one, even though this is a large range bullish day, You get 1, 2, 3, 4 days in a row where it kind of hasn't really done anything, right? Because if you just measure this candle, this bearish candle, this large bearish candle that was printed, you know, what has the price action done since then? You got 1, 2, 3, 4 days of it trading inside of that one daily range. So 4 days of it being sideways, that to me is signaling distribution. And what does it also line up with? This sell side imbalance. So once we get that, that smart money reversal, this will be our first level of distribution. Then we get another run lower. And as you guys can see, when you're getting that run lower, you're not getting the pullback. So when the market is sideways, those are the best times to enter. So when the market is really printing sideways, those are the best times to enter. Because when you're trying to enter in, when you're here and down here and down here, right, where are you putting your stop loss? There's not really a great place to put your stop loss. If you're entering it here, maybe your stop loss has to go all the way up here. Or if you're entering it down here, you don't even know where to put your stop loss if you're entering down here. Right? Maybe it's all the way up here. Maybe it's all the way up here. That's something about the market maker model that is very, very important, is understanding that even though it is very painful to try and position yourself inside of a consolidation, those are oftentimes the best times to position yourself, right? And I'm just going to take this for example. All of this price action is sideways, all right? But what would you rather do? Would you rather anticipate that this is not the smart money reversal, and would you try and go long as a, you know, trying to pick that reversal, or would you rather continue going short? Because I can guarantee you, let's say if you even take 2 shorts here and ended up losing, and you're negative 2R, and let's say you entered one last short here and made it all back, because you could probably make 3, 4, 5R on this run lower. All right, and then maybe even going short again inside of here. And as you guys can see, like, even when it's trading sideways, a lot of times we have that fair value gap that's just above us, right? This fair value gap is literally just above this entire consolidation. So if I remove all this fair value gap is just above all of this sideways price action, right? But what would happen to you if you're trying to go long inside of there and you're trying to hold it, right? At some point, it's gonna push lower, and then you're gonna get another distribution leg, and then eventually, you know, that move that you possibly would have made money on just because you're trying to pick the bottom of a market, you're not going to make it back. So that's the biggest thing, is when you're trying to trade, right, the times where you make the most money is because you haven't given up on that idea. Now, there is a point in time where you should give up on the idea and you should have an invalidation level, but when that market runs, a lot of times it's going to run without you, and you're not going to have the confidence to enter the position after you've already taken 2 losses. And that's probably where the majority of money is made. It's going to the trader that is confident in his analysis, is willing to take losses multiple times before we get the run like this. All right. So, you know, very, very simply to wrap things up here, when we're looking at different charts, just try and determine, you know, it's very easy to see the footprint of the large market. So when we get a large sell-off or a large move higher, it's very easy to see that, you know, which direction this might go. But then we're waiting when it gets to specific premiums or discounts, you know, those higher time frame levels, and then we're waiting for a smart money reversal, and then we're just going to try and enter on that next distribution phase or accumulation phase. And that's probably where the most money is made, is not trying to predict the high or low of the market. It's just really reading the market and understanding, am I in chop? Am I running out an old high? Are we going through an expansion phase right now? Because oftentimes when that market starts moving and it starts expanding, many times I don't have a trade. I have to wait patiently for the next setup. And maybe that's where a lot of you guys can learn something from, is just don't have FOMO when the market is really pushing, you know, and you've already missed the trade. Because a lot of times it's either going to pull back, it's going to consolidate for a while, and you're going to have another opportunity. All right. If you enjoyed this video but want to learn how you could trade these models live with me each and every week, just like my students here, then make sure you book a call using the link in the description. Also, don't forget to like, comment, and subscribe to the channel, as I'm dropping free value every single week. So until next time, this is Kyle signing off.